Okay, so a lot of people going into retirement. Well, real quick, how many people here are retired versus still working? Okay, retired, how many people are still working? Perfect, so a few more people retired than not. But major retirement questions, even for people right before retirement, is when can I retire, right? How much money do I need to retire is a big question for a lot of people. Will I run out of money? Even if you are retired, you might still have that question, right? And how do I turn my nest egg into income? So that's really what retirement income is, right? Your whole life, you work, you earn an income, it comes in every 2 weeks, and then someday you stop working, and that money doesn't come from your employer anymore, and how do we make sure that we have income continue to come in, and how do we do that efficiently, right? So what do we want to avoid? Well, we want to avoid 3 threats and 2 extremes, right? First, we want to avoid inflation, right? The rising cost of everything that you need and want to buy. Over a normal couple's retirement, the cost of everything you need and want to buy in your life will double or triple, right? And so we need an income that's going to combat that. We also have to be aware of longevity, right? Most of us will live right, in a 2-person retirement. The odds that at least one of them will live out till 90 is like 80-something%, right? And so we're talking about a 2 or 3 decade retirement for most people. And then volatility, right? What happens when the market crashes? What happens when COVID happens? When 2022, if 2008 happens again? What do? Right? We don't want to lose all this money that we spent 40 years growing in just a few months. So how do we address these threats with our retirement income? And how do we avoid 2 extremes, right? Over the course of your working life, right, you build up all these assets, and then you retire, right? And we want to avoid 2 extremes. First one we want to avoid is spending it down too fast. It's going down, and we're in a race to find out what's going to run out first, our money in our bank or our time left in our life, right? That's not a race that I want to be in, right? I tell my clients often, right, I don't want to be sitting across the table from you someday in 30 years and say, hey, Chuck, are you going to die soon because we're almost out of money, right? Like we don't want to be in that race, right? But we also don't want to be so afraid of this outcome happening that we hit the other extreme. We never spend our money, and it just keeps compounding for us, and we die with a mattress stuffed full of money, right? And a whole bunch of regrets of all the things that we didn't get to do. So how do we avoid both of those extremes and instead create a retirement income that allows us to do the things we want to do, as well as maintain security to know that we're never going to run out of money? That's the sweet spot that we're aiming for with good retirement planning strategies. Make sense? Question so far? Okay. We'll get rid of this guy. So the 3 threats, the 2 extremes, that's what we want to avoid. So the solution is retirement income, more specifically 3D retirement income, which we'll get into. So 3D retirement income, number 1 is direction. We need an income that rises faster than the cost of living, right? Everything gets more expensive every year. If you have a flat income, some guaranteed income that pays you the same amount every year, but everything else is getting more expensive, you are effectively getting a demotion every year, right? We need our income to rise. If you think back, 30 years ago, what were you making back in the 90s? And would you be able to survive on that today? Probably not. And so in the same way, we need our income to keep rising to outpace inflation. We also need duration. We need income that lasts longer than you and yours. Right? For many people, right, if you're married, you want it to live longer than you, but you also want it to live longer than your spouse. You don't want them to, if they outlive you, you want to make sure that they're taken care of for as long as possible. And so again, we don't have to be worrying about how long are we going to live and hoping that we die soon so that we don't run out of money. And then lastly, diversion. We want income that flexes better than the stock market. Right? Market does it's all over the place. Sometimes it's way up, sometimes it's way down. And how do we make sure that we have an income that regardless of what the market's doing, that we're not dependent on the market always being at all-time highs, or the economy always being awesome, or politics always being smooth and peaceful, right? Because those things are never going to happen. So how do we make sure that we can divert from one thing to another if we have to, depending on what's happening in the real world, okay? So today what we want to cover is first retirement. If we're talking about retirement income, first we have to cover retirement expenses briefly. And then we want to talk about retirement income. Social Security, pensions, annuities, investments. Those are the common big 4 places that people get a lot of their retirement income. So we'll hit all of them. Not super hard. We have a whole separate AFIA workshop we do on Social Security. A couple of you have maybe been to that. We'll run it again at some point. And so we hit that harder then, but we'll hit some of it today. Okay, so retirement expenses. First of all, obviously we have living expenses. Just what do we want to do to live? Usually in my planning, I don't ask people for budgets because unless you've been budgeting religiously for a long time, they're never accurate, right? We'll say to a couple, so hey, how much do you think you need to live on in retirement? And they try to like add up their expenses, and they might say, oh, I think we live on $5,000 a month. It's like, okay, great. Well, your take-home pay is $10,000 a month. So is your savings account growing by $5,000 a month? And they say, no, it's not. Okay, so your expenses aren't $5,000 a month then, they're $10,000. Because if you make X, right? If we make X, and at the end of the month, there's nothing extra left over, then we spent X, right? It's the same. So unless people are really good at budgeting, we usually just say, hey, whatever you spend on a monthly basis after taxes, after insurance, after mortgages, all that stuff, right? That's your living expenses. And most people can make that work with whatever, right? So I don't need what you think your utility bills are going to be in 10 years because who cares, right? But as long as you have like, hey, here's your living expenses, those will continue, that's a good place to start, right? And so some things will, some things like a mortgage will get paid off, that will go away. Other things like maybe you have heavily subsidized employer insurance and then you go onto Medicare and it's more expensive, right? That can happen to some people. Like some of those things will change, but you have your base living expenses. Then we have, for a lot of people, like a phased retirement expenses, right? Where you may have heard of this, right? Your go-go years, when you first retire, right? Every day's a Saturday, every night's a Friday night. You have more money than you've ever had, more time than you've ever had, and the most health that you're going to have going forward, right? And so it's a good time at the front end of retirement to do some things, right? To maybe spend an unsustainable amount so you can enjoy life while you can. And I've talked to way too many people in their late 70s, 80s, who didn't do all the things, right? Who were afraid of extreme number 1, and so they ended up in extreme number 2 and didn't do anything while they could, and now are regretting it. But now they don't like to travel. It's not fun. It's uncomfortable. There's nothing left that they want to do, right? And so a lot of times, if we can, we plan to do go-go years. We plan to spend an unsustainable amount up front so we can go do some things. And then you get your slow-go years that start slowing down a little bit, and eventually your no-go years where you're just like, we'll just stay, right? People can come to us if they want to. So you kind of have that. And then as our spending, our extra fund spending goes down though, often our healthcare costs go up, right? Because we're not going to get any healthier going forward, right? And so these kind of end up being the major categories of retirement expenses. And a lot of times people will have you like, hey, go do a big retirement budget. Again, unless you've been doing regular working budgets, doing a retirement budget's not going to matter. Just what do you need to live on now? Can we maintain that in retirement? Do we want to spend more for go-go? Can we plan to spend less later on? And are we accounting for higher healthcare costs later on? Questions so far on any of this? Make sense? So if we look at just kind of going forward, right? You have timeline going this way, 5 years out from retirement, 4, etc. Retirement year. For a lot of people, like if this is your red line is your expenses, if the blue lines, the blue columns are your income each year, most people, while they're working, they make more each year than they did before. If nothing else, inflation raises, cost of living adjustments, maybe a promotion or so. So your income goes up, your expenses go up. And for most people, their income is more than their expenses because they're saving money, right? You put money in your 401k, your Roth IRAs, etc. And so, good, you're living on less than you make. Awesome. Well, when you're retired, you don't need to keep making more than you live on, right? You only need to live on what we're doing. And so once we reach retirement, again, this is where for some people, let's draw on this a little bit here. For some people, they just want that expenses to stay the same. I just want, if I could just do what I'm doing now, I'd be happy. For some people, they want to really go ham for 10 years or so, and then they can, go slow go and no go after that. And for some people, they spend a lot of money because they're working and whatnot, and they think, I just want a simple life. And honestly, I'd rather live on that and retire earlier than have to work all the way to the point where I can maintain my lifestyle, right? So there's a bunch of different ways you could do that, but that is one thing you would want to evaluate as you're planning your retirement. So we'll say for a lot of people that it goes up for 10 years and it kind of goes down. They're like, all right, we're done doing our really big trips, but we're still doing some trips. That keeps growing with inflation, and then your slow go years, etc., going out. Make sense so far? So we had all this, before all this expenses was covered by working income, salaries, earned income, etc. How do we then match this expense later on, especially with it growing, with retirement income? That's the goal, right? So if we take this out, so we'll be looking at the 4 different types of income, and we will be evaluating all of them based on the 3 criteria. Direction, duration, diversion. Does it outpace inflation? Does it outlast you? And does it outperform other things that we could be doing? Okay? So first one, Social Security. Again, I'm not going to go super deep on this because we have a whole other workshop on that. But it's based on your highest 35 years of income. You have a full retirement age. A lot of people at 67, unless you were already been on it for a while, then it could have been anywhere from 65 to 67. There's this big phase out. Some of you, it's like 66 and some odd months. If you claim it at then, your main projection is based on that age, right? And then if you claim it earlier, all the way up till 62, you take a penalty. Each month you claim earlier than that, it reduces your monthly benefit. If you delay, you get delayed credits, right? Welcome. So you can go all the way till 70, and you can get more income per month waiting that long. You can't go any longer than that. You should just take it at 70. It doesn't get any bigger, right? So for most people, they can claim it sometime between 62 and 70. And if you retire before that, you got to come up with a bigger gap before then. And if you retire after that or claim it after that, then you just keep up money. So don't do that, right? And so for a lot of people, I'm going to adjust. I adjusted the expenses down and just took inflation out because it's kind of hard to pay attention to the inflation otherwise, right? So if we correct for inflation, for a lot of people, they have their working years, expenses are still up here, and then they have Social Security as a base, right? And so for this couple, Chuck and Diane, we got Chuck's Social Security, we've got Diane's Social Security, assuming they both take it at the same time in the year that they retire, right? And then when one of them passes away, so we have Chuck passing away after 25 years, and Diane living another 5 or 6 years after that, right? What essentially happens is that the survivor keeps the larger of the two, right? What's actually happening is that Diane keeps hers and then gets a survivor benefit that raises hers up to the level of the larger one, right? So when one of them dies, they do lose that chunk of income, and they need to make sure they replace that. Yes?
Does that happen automatically when somebody dies?
You
have to contact them and...
You would want to make sure. I would not trust that would happen automatically. Sometimes it does, and sometimes they don't put it together, even though you've been filing together and all that.
I'm not going to contact Social Security to make that change.
Yeah. I wouldn't trust the government to do anything automatically except charge you taxes. So that's generally how it happens, right? And so you can move this around, right? Again, you could delay this out 5 years. Oops, let's just grab my thing again. Let's put it to blue. So we could delay this out 5 years, and then his might be this high, and hers might be this high, right? And then they have more overall, but they have to wait longer to get it, which means that if they're still trying to retire here and spend this amount of income, now they need to make up all of this with retirement income or with other distributions instead of just this, right? So they have to withdraw a lot more out of the other accounts to make that up, depending on when they claim it. Right? There's a lot of Social Security claiming strategies. We covered a bunch of those in the other workshop. A lot of ones that you read online are based on Social Security in a vacuum, which is not how you should calculate where you take Social Security. You should calculate it along with everything else that you have. Right? Question so far? Social Security always has given a cost of living adjustment. They are also running out of money. So we'll see what happens going forward. It will not go away. It's too big of a train. It's moving too fast. But they're obviously going to have to make some adjustments to make sure that they can continue to pay because they're slowly spending down that trust fund, and that's supposed to run out in like 2034 or 2033, somewhere in there. And then they're either going to have to cut benefits, raise taxes, get rid of the wage base, a bunch of other things that they could do. Kickbacks, Social Security claiming ages again. They have a whole bunch of levers they can pull, and what they'll do is they won't solve it because our government doesn't solve anything, right? They kick it down the road to make it somebody else's problem. So.
And they're talking like a 25% decrease.
Yeah, if they just decrease, it would have to be pretty severe. My guess is that they'll pull a combination of levers because people on Social Security vote. Yep. All right, and so even though we've been mismanaging it for the last 30 years, the people who then claim on all that mismanagement will vote people out who strike them too severely, and we'll kick it off to the next generation to deal with.
Our generation, the pig and the python, that's how I learned it.
Yeah.
It's just a larger group of people that is being sustained by a smaller group of people they're following.
Yep, that's true.
A lot of the problem.
Yep. So yeah, we'll see. They'll wait until probably 2033 to do anything about that because that's how they roll. Okay. So Social Security, good base for this stuff. Let's see, I need to, what is going on here? Come on, there it goes. Okay, so Social Security, I would put here, right? It doesn't really outpace inflation, but it keeps up with inflation, generally. They'll adjust that cost of living adjustment to sort of do inflation. In 2022, or in 2023, they had that big, like 7-point-something% adjustment because inflation was so high in 2022, right? And now it's back down to, it was 2.8% this past year. So generally keeps up with inflation. Also, generally, it doesn't outlast you, but it will at least last as long as you do, right? So doesn't quite outpace, doesn't quite outlast, but at least keeps up with both of those things, right? So we're gonna put it there. And it's just static, right? We can't adjust it after you pull it. It comes in like clockwork. You can't adjust anything. You can't wiggle anything. You can't flex it at all. So it doesn't help you there. Not a bad thing. Good stability, good base for most people. Overall, it's probably good that we have it, even though some people would love to have not contributed to it and have put their money elsewhere to do better. The vast majority of people would not have saved anything, and so it's better that we have it overall than that we don't. So Social Security. Any other questions on Social Security quick? Otherwise, if you got on this list, you'll be on the list for the next time we do a whole workshop on that, and I would encourage you to come. There's a lot more details in there. But any big questions on Social Security? Okay. Pensions are another big one. Anybody here have a pension? Okay, a few people. If no one did, I would just skip the whole section. So, okay, right, pensions, right, lifetime income. For a lot of people, they have a joint and survivor option. You got to be careful about this though, because like with anybody have the Wisconsin retirement system ETF? Few people, perfect. So right, so like the main statement that you get, and they give you that projection on the bottom of page 1, that's your single life amount. That's what you get just on your life at age 55 and 65. Right? But if you take that amount and you die, your spouse gets nothing, and the pension just ends right there. And so most people would take a joint and survivor option, where some amount, you take a lower amount now, forever, and then when you pass away, some percentage would go on to your spouse. Right? The more you want to go to your spouse, the lower the cut you're going to take now. So if you want 100% to continue on to your spouse, that's going to be the lowest amount of income that you're going to get starting today. Right? And if you want only 50% of it going to your spouse, you'll get a higher amount now, but then obviously it gets cut in half when you pass away. Right? And so a lot of times my favorite one is like either like the 75% or like with the Wisconsin one, it has the reduced by 25% if either one of them go. Part of that is because it gives you a higher upfront, because right, best chances are that you're both going to live for a long time together, and then one passes away, and then a few years later the other one does. Right? Sometimes you have someone outlives by 10, 20 years, but not often. So that gives you a higher income now while you're still both working together. And then if one of you goes away, your expenses do come down some. They don't get cut in half, because property taxes are the same whether there are 1 or 2 people living in the house. Right? Can't really buy less than a dozen eggs. Right? You were already pretty much down to 1 car anyway, so your vehicle expenses are not going to get cut in half when one of you passes away. But they will come down. And so if you lose 25% of that income stream, but your expenses have also come down by about 25%, that's not the worst thing. Right? So that's my favorite one. It's obviously heavily dependent on your situation and all of that, but that's the one we usually end up settling on. Whether or not they're good depends on the solvency of whoever's issuing them. Right? And so if it's a company pension, you are depending that company is managing that correctly and that they'll be around to continue to pay that pension forever. If it's a state-run pension, you are assuming that the government's doing a good job with their pension fund and that it's not going to go bankrupt.
For pensions, are there laws that dictate there has to be so much put away?
Yes. So there's some weird stuff with that, right? And there's like the pension guaranteed fund and all these other things, right? That'll provide some protections for that. And so it's not like it's a huge risk, but it's not no risk either. So different states, so Wisconsin is really good. Last time I checked, it was like 110, 112% funded. So for all their promises of everything they have to pay out, they have more money than they've promised out, which is a good thing. Last I checked, Illinois was like 32% funded. So they've literally promised 3 times as much to their retirees as they have money to pay it. So I don't know how that, like, how did, if we're supposed to have, how did that happen? I don't know, right? I don't know the whole history of and I don't live in Illinois, and I don't have any Illinois clients, so I haven't looked into it too much. Kentucky's also, I think, really bad or really good, one of the two. There's only like 2 states that have 100% plus funding rate. Washington? Okay. Yep, could be. So yeah, And then, company pensions, the other thing is it may inflate, right? So again, Wisconsin runs theirs very well. And part of it is that they don't promise a cost of living adjustment. It's not promised. They pretty much have always done it, but they don't promise it. And they fluctuate it based on how it's actually doing instead of just making promises they can't back up like Illinois did, right? And so it often inflates, but then like UPS, right? I've got some UPS clients, their pension does not inflate. It's the same amount monthly for life. And so again, if you think back to the income you were making 30 years ago, if that's all you were making now, would that be enough? Probably not. So in the same way, you don't want a pension that is flat. A flat income amid rising costs is basically a pay cut every year, right? And so sometimes they're good, sometimes they're good. A lot of pensions then will offer a lump sum, right? They say, hey, you can get this amount per month for single, joint survivor, or whatever else, or you can take this big lump sum and just take your money and run, see if you can do better, right? So the question is, do you take the lump sum or the stream? So for the Wisconsin Retirement Systems Employee Trust Fund, Wisconsin pension, the answer is almost always no. You don't take the lump sum, you take the pension. Again, it's 100% plus funded. You also lose the employer's half if you try to take the lump sum, and there's no way you're making that back. The only difference would be if you've only worked there for a couple years and it's really small, they don't want to fool around with paying you $214 a month for the rest of your life. So they're just like, take it. You can have the employer side too. But for the most part, you would not take the lump sum on that one. Other states, again, if you got solvency issues with your state, I would probably take it. I don't know that I would trust Illinois to make sure that they're going to be solvent for the next 30 years. And if it's a flat pension, if it does not increase, does not have any cost of living adjustments, I would probably take the lump sum. Ultimately, it comes to, can you recreate the same income, but with a legacy? Right? Because again, even if you take a joint survivor option, when you and your spouse pass away, the money is gone. And a lot of times their payouts are a little bit better than what you might try to do with investments, but the point of investment income is that you have something left over at the end, which is why you don't pull as much out of it. And so if you can pull basically the same thing out of investments, maybe a little bit less, but then you have a lot more at the end, and you care about legacy and passing things on, then you might want to take the lump sum and do that instead. Any other questions on pensions? There's only like 4 of you with them, so I don't want to spend too much time on it. So all right, if you had a pension then and it increased with the cost of living, it would be flat, right? This is actually about 75% of this one, but you barely notice, right? It looks pretty much the same. And so again, your expenses have come down, but so have your income. Since this is without inflation, if you did not have a cost of living adjustment, this line would be progressively smaller and smaller. Right? That's what it looks like in real dollars to my UPS clients. Okay, so pensions. Generally, I would put down here, right? Usually will last your whole lifetime. A lot of them don't have cost of living adjustments, or they're really bad. It's like 1 point. We have a couple clients that their thing is like 1.2. It's like the lesser of 1.2% or inflation. So AKA always about half of what inflation is. And so again, it's not keeping up with inflation. So a lot of it would be here. ETF would be right about where Social Security is, right? So they've done a good job with that one. But generally, okay, so retirement income, Social Security, pensions, annuities then. So annuities would be, you've got your 401k, you've got a big pile of income, and insurance company says, hey, give us a big chunk of that money, and we will create a personal pension for you. We will guarantee you income for life off of this, right? You give us 300 grand, we'll give you 5% of that annually in monthly installments for the rest of your life as long as you live, right? And they might say things like, if you invest, you can take 4%, that's the safe withdrawal rate, right? We'll talk about that in a minute, but we'll pay you 5%, and we'll pay it to you forever. So whether you live to 80, 90, or 110, you'll always get those payments as long as you live. And they're guaranteed. Can't make guarantees about the stock market, right? And so it's a pretty tempting choice. And a lot of times they'll say, don't do all of it, just do some of it, right? So it's guaranteed, that's pretty great. The problem with a lot of them that are kind of ignored, I could go on and on about these, but the problem with a lot of them is that it's a flat income, right? If you put $1 million in there and they give you 5% of that, it'd be 50 grand a year, and it's 50 grand forever, even though your expenses are rising, right? And if they do say, well, we do have a cost of living adjustment rider that we can put on there to give you a bump, but now our initial payment's going to drop to 3.75. And so we'll drop your payment so it goes up, but at that point, it's not really any better than what you could get elsewhere. And for most people's life expectancy, if you do the math, if you just stuck your money, because again, it's a pension, it's an annuity, so at the end you get nothing, right? When you die, your heirs get nothing left. And so if you just do the math on a normal life expectancy, usually the rate of return is like 3.5%, right? Which means you could probably duplicate that with just CDs. So that wouldn't be the same guarantees, but it's not like this amazing product. It's not doing that much. So I don't care for most of them because they're not as good as people think. And then again, no legacy. When it's over, it's over. You can do the survivor benefits, you can do all that, and then it's gone, right? So it can be okay, but they're way oversold and they overpromise and underdeliver in pretty much every experience that I've had with them. So they're very popular because they pay giant commissions to people who sell them, right? If they can convince you to put 300 grand in there, then they ride off with their $21,000 commission to Tahiti or wherever. Like, that's a pretty good deal. So it can skew people's belief about how good they are because they see the commission paycheck that's attached to them. And so it can, you can talk yourself into thinking they're amazing. So don't love annuities for all those reasons, or those other two reasons. So annuities, did I put them on here? Yeah, I also put down here. Again, either they don't have any cost of living adjustment at all. They will last you forever, so that's good. But they have either none, or if they do, then the payout's so low that it's just not that great. Okay, so I didn't even put them in here because I don't. So if you have this base, though, you got Social Security plus pension, then for most people, the rest of this has to be made up with investment withdrawals. Right? You got a big chunk of money, 401k for a lot of people, maybe other investments, and we would just withdraw. Right? Again, we're not going to withdraw more than our expenses, because that'd be dumb. We're just going to pull out of our various accounts enough to pay our expenses each year, and then that would be a variable amount based on how much we're actually spending. Right? Questions so far on anything that we've covered before we jump into this chunk of it? How are we doing on time? All right. Okay, so retirement income, investment withdrawals. So you may have heard of this, the 4% rule, or the safe withdrawal rate. So this is supposed to be the rate, hey, this is the amount that you can pull out of your investments, your retirement investments, every year without having to worry if you're going to run out of money, right? And so people have made it this 4% rule. Insurance companies, again, love it because then they can compare that with their 5% payout rate on their annuities or whatever else. There's a lot of misconceptions around this one. The way this came about is someone did a bunch of research on looking back at rolling 30-year periods. So if you say, hey, what's the rolling average return of a portfolio that is 60% equities, 60% stocks, 40% bonds. So they took that general portfolio, ran it monthly or weekly or something, I think it was weekly even, for every week going back 30 years. So you'd start from this week, what was it for the last 30 years? And then you start a week ago, what was it for that 30 years? A week ago, what was it for that 30 years, et cetera, all the way back. And they said, at what percent, and then they ran all these different percentages. What happens if you take 8% per year? What happens if you take 7.5% a year, 7, 6.5, et cetera, all the way down? And what they were looking for is, at high withdrawal rates, how often would it break? Right? How often would you have run out of money if you were trying to take 7% per year out of your account? And at 7% per year, like 50% of the time it would break. But like half the time, they had plenty of money and they were pulling almost twice this out. And they still didn't run out of money. Just depends on what the market did during that 30 years, right? And what he did is he had back all the way back to like 4.3 was finally the withdrawal rate, where across all 30-year periods for like the last 100 years, you never would have run out of money, right? Again, you could pull way more than that in other periods. This was just like the worst one. And this is just assumed you always pulled the same amount no matter what was happening. But again, I think most people can shift their income around. And so it was like 4.3, 4.4, something like that, and then people rounded it down to 4. And they said, hey, you can only take 4% out of your account each year. And I just don't think that's true. Not if you allocate it properly, not if you have a good plan. So there's that. Again, they like to compare it to annuities and stuff. You also do have sequence of return risk. This just means that depending on when your returns come, heavily impact your final destination. Right? So let's say that from the time you retire to the time you die 30 years later, your average return of your stocks was 10%. Right? Well, if you had really high returns up front, like a lot of really, really good years, and then bad returns on the back end, still average 10%, but you would have so much money on the front end that you'd be just fine. Right? But if you had all the bad years up front and then really good 20 plus years on the back end, the problem is you spent down all your money and lost too much of it at the beginning, and you didn't have enough money to take advantage of those good years, and you could have wildly different results based on not the average return over 30 years, but when those returns occurred. Does that make sense? Yep. So that is a real thing. Even if you average 10%, we don't know when that 10% is going to come. Right? And then asset allocation, right? Where do you keep your money? Is it in stocks? Is it in bonds, CDs, all these other things? And so there's this notion that when you're working, you're in accumulation, right? You're trying to accumulate a nest egg. And then when you're in retirement, you want to preserve it. You just don't want to lose it. Right? That's the name of the game for a lot of people. So that's where you get like the 60-40 portfolio. You should be, hey, when you're early on in your working years, be 100% equities. Be aggressive. Let it grow. Right? And then as you get into retirement, you would pull back, preserve some of that, put more and more into bonds and CDs and those types of things, right? Or you've got like rules of thumb like 110 minus your age. So you take 110, subtract your age, that's how much you should have in equities. So 110 minus, if you're 60 years old, 110 minus 60 is 50, so you'd have 50% in equities. 110 minus 70 is 40, so you'd have 40% in equities, and you just gradually shift more and more down. Target date funds follow stuff like that, right? The older you get, the more conservative, the more it pushes you into bonds and CDs and stuff. So let's see here. This is where I'm gonna pivot, and one or two of you I think have seen this before, so you're just gonna have to see it again. So with the asset allocation thing, because this is going to be a big part of retirement income. Because again, when you're working and you're just every 2 weeks you're throwing money in your 401k, doesn't matter as much what the market's doing. It's going to do what it's going to do. When you are now living on that money, it matters a lot more. And you feel the downturns a lot more. And pulling money out every 2 weeks or once a month is a lot different than putting money in, right? And so how we invest it is really important. So if you had to choose, right? Let's say you're here and you've got some amount of money, however much you have, and we're going forward. You might be retired already. Maybe you have yet to retire. Somewhere out here, you're going to pass away. But you don't know when. And you don't know how long this money has to last. Right? And you have to choose, what do I invest in? Do I invest in fixed income or equities? And let's say that for this example, this is retirement here. Okay, so you could invest in fixed income. And if you did that, your money would fluctuate a little bit. And if you never touched it, it would compound a little bit, and you'd probably average, 3 to 5% long term, maybe. Right? It would do something like that. Except that as soon as you cross this line, you're not leaving it alone anymore. You're spending it, right? And so as you spend it, some of it you are spending is just the interest that it earns. But if you're trying to pull more than the interest that it earns, which you're going to need to, because again, your expenses keep going up. And so if you're making, 4% here, but you're also trying to pull out 4%, well, the next year you're going to need to pull out more than 4% because your expenses went up. So you're going to pull out a little bit more, which means you're pulling out the interest plus a little bit of principal. And then the next year, because you pull out some principal, it doesn't make as much interest. So you need to pull out a little bit more principal. And so you spend more and more of the principal, and so that as you spend it down, that curve goes faster and faster down because the less money you have, the less interest it's generating, and the more principal you need to pull out to make up for that increasing income. Does that make sense? So if you invested 100% in fixed income, 100% in bonds and CDs, and you were trying to make a healthy withdrawal rate, you would be in that race to see what runs out first. Not the race I want to be in. You could just pull back, and you could just say, well, hey, if I'm making 4% here, and I need it to go up by 3% a year, I could just pull out like 1 or 2% of my retirement assets per year. And you could do that, and it would last on fixed income. But also seems like kind of a waste when it's literally half of what you could be spending, right? So that's one option. The other option is that you invest it all in equities. And I call them equities, right? They're stocks, stock funds. I always call them equities because when I think of stocks, I think of white dudes on the New York Stock Exchange floor yelling buy and sell and all the craziness that is the nebulous stock market, right? And when I think of equities, I think of the equity that you have in your home. Many of you have a home, you had a mortgage, you started paying it down. As you paid that mortgage down, your equity or your ownership in that house increased. And if you have a paid off house, then you now have 100% equity or 100% ownership in your home, right? And so in the same way, does anyone here own a business or did own a business? One, Anybody here have stocks or stock mutual funds in any of their accounts? Okay, so everyone should have raised their hand for the first question too. Because if you own stocks or stock funds, you are a business owner of some of the best businesses in the world. That's literally what that means. Like, you own stock, you own shares, you are owners of the best businesses in the world. And when I look around locally here, the people who have the most money are the people that own the businesses. Right? Think of like the Zitlows who own Quick Trip. I think they're doing okay. Right? And they got that way by owning good businesses. And when that happens, right, when the businesses are doing well, you do really well. And when the businesses go through a rough time, leaders eat last. Right? And so you feel that. But in general, the returns are much better. And it might look something like that. Right? Oops. What did I do there? I think I hit the button. Let's go back. There we go. Right? Fun stuff. Okay. Could look like this. Whatever. And in general, over 100 years or so, equities, S&P 500, et cetera, have averaged 8 to 12%. Right? And so you're like, okay, let's just call it 10. So it's like, 2.5 times what fixed income has done. But if you think about it, if inflation this whole time is also growing at 3%, our real return on fixed income is like 1, and our real return on this one is 7. And so really, when you compare the real returns of equities are 6 to 7 times that of fixed income. Right? And so, you'll just do way better being a business owner. And for me, I'd rather be an owner than a loaner. Right? You can either own businesses or you can loan your money to them. And the people who've really made a lot of money are the ones who own the business, not loaned them to them. So, but, right, it's different when you're in retirement and, it's all going great. But again, once you pass this line, you're no longer putting money in, now you're pulling money out. Right? And so this is what it would do if you left it alone, but you're not leaving it alone. You're pulling money out. And so you're always a little bit before. And sometimes you have these really good periods and it's great. And you pulled out 50 grand that year, but your account's made 80. And you're like, wow, this is awesome. I took a bunch of money out and I still have more money at the end of the year than I started with. Love that. And then 2020 happens. Global pandemic, rapid inflation, whatever the next problem is, right? And it goes down, and in the space of, a month, 3 months, you lose 30% of the value of your funds. And especially if that happens, let's say that happens early on, right? You retire, everything's great, you retire, and now you're pulling money out of here. And again, it will come back, but you don't have as much to come back because you've been pulling money out, right? And so it recovers a little bit, but then it goes down again, and now you're spending more and more. And so again, sequence of returns, you might still last longer, but you can still run out if you have really big downturns early on, right? And so either one, going all fixed income or all equities, either one runs the risk of running out of money, even though equity returns are way better than fixed income returns.
So what's the magic balance?
Yes, sir. He knows where I'm going with this. Okay, so what is the balance, right? Is it 60-40? Is it 110 minus your age? All these things. And a lot of this is built on, right, percentages. Hey, you should have X percent in both, usually based on your age and nothing else. Right? So I'm going to look at you and I'm going to boil your entire financial situation down to just your age and nothing else, which seems dumb to me. Right? Or they'll do a risk tolerance questionnaire where they'll give you 5 to 10 questions. It'll take you 5 minutes. And you're filling out in an air-conditioned office when the market's at an all-time high. And that's supposed to tell you how you're going to react when the value of your account is split in half. And it's not accurate. Right? And so I think, right, if you're spending 5 minutes to determine how you invest your life savings, that just doesn't seem like enough time to me. Right? People spend more time trying to figure out what to watch on Netflix than they do on how to invest their life savings. I think that's backwards. Right? And so I don't do it by percentages. Mostly because we don't operate with percentages in the real world, right? So think about where you shop for groceries. Let's say Woodman's in town here. So you go there, you fill up your cart, load it up, and you go to the cashier. They're ringing it all up, and you pull out your debit card, right? Because they don't take credit cards there. And does the cashier look you in the eye and say, That'll be 17.8% of your paycheck, please. No. I mean, it might be, but that's not what they're going to say. They're going to give you a dollar amount, right? Because in the real world, we operate on dollar amounts, not percentages. So I don't think we should base this off percentages. I think we should base it off of dollar amounts. Specifically, right, when the market goes down in retirement, the one thing we don't want to do is sell low, right? We want to buy low and we want to sell high. That's the magic of investing, right? And when you're working, you're always buying. And when you're retired, you're always selling, right? And so how do we balance those? So the way that we do it, right, is we say, okay, we want to make sure that when, not if the market goes down, that we never need to sell low. And so first we say, let's build a safety bucket of fixed income that will be there to insure against the downturns. And then we put the rest of our money in equities and be good business owners. And we buy good businesses and we just hold on to them and reap the profits and the appreciation and just sell a little bit off when we need money. Right? And so, what's the balance? How do we do this? For me, it's not percentages, it's years. Specifically, if we're trying to, right, when the market's up, which is 3 out of 4 years on average, the market's up, we would just sell high, sell, and take any income out of our equities when they're high. Right? And when, not if the market goes down, which on average is 1 out of 4 years. It's not every 4th year, otherwise I wouldn't have a job. But it does happen. We would stop taking money out of our equities and sell out of our fixed income instead. Because our fixed income's not going anywhere. It's just going to trot along at a few percentages. But we would wait, so market starts going down, you cut off your income here, you pull out a fixed income, you wait for the market to come back, and then when it recovers its all-time high, you switch back and pull out of equities instead. Right? And you just alternate based on where the market's at, where you're pulling your income. Historically, whenever the market has gone down, it has always come back and gone on a tear afterwards. And when that happens, then you can refill your safety bucket from your equities. Be ready for the next one. And so we'd say, hey, so then the amount we want in here is just enough to protect this. And so we say, hey, well, how long do we need? What do we need to protect it against? And so most bear markets are 2 years or less. Most declines in the market are 2 years or less. Right? COVID was 6 months. Global pandemic, entire economy shut down, 6 months, the market was back. Doesn't make any sense. But that's what happened. Right? This whole Iran deal thing is still sort of happening overseas, but the market recovered in a month. 2018 was 7 months. 2022 through 2023 started with the whole Russia invading Ukraine, inflation. You guys remember all that, right? It was not that long ago. 2 years and a week to come back, right? So you'd want minimally 2 years of withdrawals, not total income, not total expenses. Because again, you have a base of Social Security. So we only need those yellow bars, right? That's the part that we need to pull out of here. So we need at least 2 years. And then what if we have another 2008? Right, another great financial crisis where the whole thing goes down really far and it takes 4.5, 5 years to get back. Okay, great. We can hopefully don't have another one. We had great depression, great recession, 90 years apart. Hopefully we don't have another one in our lifetimes. But in case we do, we might say, hey, we could go all the way up to 5, maybe even 6 years. So we usually say 2 to 5 years of withdrawals, set aside in your fixed income, the rest in equities, which is going to work out to more like 80-20, 85-15, somewhere in there depending on your assets, which is obviously way more aggressive than your average 60-40, 50-50 portfolio. But you're also going to have way more money making 7x the real return of your fixed income. Harder to do in practice. Because it's one thing, again, markets that are an all-time high, it sounds great now. Way harder when you look at your statement, it says minus 37. And you see, minus 420 grand. And you're like, well, dang. It took me a lifetime to get to that in the first place, and I just lost it in 6 months. Which is a critical component, right? And we're going to take a break in just a minute here, but this is really important. how we phrase things, how we think about things matters a lot, right? And so most of you, I would say, probably own a home. Many of you bought it a long time ago. Let's say you bought a house some odd decades ago and you paid like $100,000 for it. And you own it for a long time and now it's worth $400,000. I don't know, whatever. Insert your own numbers if you want. Did the value of that house just go straight up? No. The value of your house is only worth what someone's willing to pay you for it. And so it depends on supply and demand and a whole other host of factors. Right? So the value of your house actually went like this. The difference is we don't have a screen above your door telling you every single day exactly what your house is worth. Right? You only really know when you put it up for sale. Maybe you look at Zillow or Realtor.com every once in a while just to get an idea. But you're not doing it daily and it doesn't update daily. So your house is actually very volatile. But most of us would say, yeah, housing feels like a pretty safe investment. But it's just because you don't see it. You don't see the volatility, right? And so let's say that you said, hey, we got to move. So we list it. We think it's worth $400,000. We list it. We get a bunch of showings. Bidding war starts, right? All these offers are flooding in, and you get an offer for $440,000, top offer. And you're like, whoa, man, we just made $40,000 overnight. This is sweet. But like the responsible, wise people you are, you decide that you're going to sleep on it before you accept any of the offers. So you sleep on it. Overnight, storm rolls in. Lightning strikes the big tree next to your house. You know the one, right? Branch comes through your roof, destroys the seat. No one's injured, but now your house is like a wreck. Everybody hears about like, isn't that the neighborhood that we just put an offer in yesterday? They run over, they see the damage, and everyone retracts their offers before you can accept any of them. You're like, so close. But you're like, whatever, we got homeowners insurance. They'll fix it, right? They'll pay for it. $1,000 deductible, paid, done deal. But people don't seem to see the vision, right? So you leave it on the market and you still get offers, but they're not $440, they're not $400. Now the best offer you get is for, where's my pen? For $300,000. So you went from 100 to 400 to 440 to 300. This one literally overnight. Have we lost money? In some ways, right? No, still way up from what we paid for it. In other ways, kind of feels like it because we just had 440 in our hands a minute ago and now it's $300,000. But ultimately, right, we've only lost money if we say, yes, I will sell for that amount. Right? The only way to turn a temporary decline into a permanent loss is to sell while the value is down. I'm going to say it one more time. Right? The only way to turn a temporary decline into a permanent loss is to sell while the value is down. In this case, you say, no, we're not doing that. We're not idiots. We know that the intrinsic value of our home is more than $300,000. We know that insurance will fix this. We don't know how long it's going to take. We just know that it will eventually happen. So you take it off the market, insurance comes in, fixes the roof, can't color match the siding, has to replace all that. You put it back on the market 6 months later, it's all new siding, all new roof, you sell it for $500. Temporary decline, eventually recovers, goes on to new heights. What does that remind us of? Stock market. And the only way to turn a temporary decline in the value of your businesses, not the stock market, it's not gambling. When the value of your businesses goes down, you still have the same number of shares, the same number of ownership interests in those businesses. And the only way to lose is if you give some of those up for less than you know they're worth. And so we just say no, and critically, right, we have to have the ability to say no. If you had to move no matter what, and you couldn't afford a second mortgage on top of this one, and so you had to say yes, you'd be forced to sell when the value's down. But if you do it right, and you structure it right, you can go and say, hey, I don't need to sell when it's down because I've got my safety bucket, and I can sell out of this instead while I wait for this to recover. And I don't know when it will recover, I only know that it will recover. Right? Easier said than done. This is a lot of what I do is just convince people to invest and convince them to stay invested. It's more details than that, but that's the main thing. Questions? Yes.
So if you have retired and you don't really need to pull out of that, is it okay to invest more in equities and fixed income than, because you're not spending that money right away,
Mhm.
or maybe even for a really long time?
Yep. Yeah, so there's a lot of people that run into that, right, where they don't actually need to like optimize they don't need to make more. Right? It's like they're only going to pull 2% out anyway. They're not going to pull anything until their RMDs, and then they're going to have to pull those out and just probably reinvest them. You see that a lot. It's hard to save diligently for 40 years and then just flip that switch and start spending it.
You don't need it, but the thing is, the required minimum disbursement, that happens when you're 72, 73?
Yeah, between 73 and 75 if you haven't hit it yet. If you're born after 1960 or later, it's 75 for you. It's some other age if you're before that. Yeah, and you could just reinvest those, right? Right, that's where my challenge to clients is, you sure you don't want to spend it? Can't take it with you. If it's all going to go to the kids, do we need to wait until you die and they inherit it in their 60s when they're already fine? Or should we come up with a plan to start giving it to them now? Oh, we don't want to spoil them. That's fine. Is there some cause, some good thing that we could put it into instead of sticking it away in CDs and earning nothing and making no impact? Right? And it becomes more personal and less finance. Right? But right, do we have to do this? No, not if you're not trying to like get the most out of it. But even if you're not, I still say be good stewards of it. Right? Be wise with it. Get as much out of it as you can, and then give as much of it away, maybe, as you want, or leave a huge legacy to something, or get a building with your name on it. I don't know, right? There are things to do with it still. So yeah, that definitely becomes way more of a personal conversation. And I would say, right, the people that end up working with me are way often in the we didn't spend enough, we saved way too much. And now, most of our conversations are, how can we get you to spend more of this and enjoy it while you can? Then you got to rein it back, or you're going to run out of money. I don't know if that doesn't really answer your question, but things to think about. Yeah, things to think about. Other questions? Right. So one quick thing, right? A lot of you will have target date funds or balanced funds, which are just combinations of the two. Because most people wouldn't say I'm an aggressive investor in retirement, and most people wouldn't say I'm a conservative investor. I'm moderate aggressive. I'm moderate conservative. Right? We all want to be moderate. And so they say, what's in the middle? And there's nothing in the middle. There's only combinations of the two. And so they put those together because people know they want more than this, but they don't like the minus 30. And so they get in a balance fund, they get in a target date fund, they get in a 50-50 fund or 60-40 fund, and ultimately it's just 60% this and 40% this, but in one fund, one purple bucket where all your money comes out of that, and regardless of what the equities inside of there are doing, you are selling out 60% equities, 40% bonds. And so when the market goes down, all the money you're pulling out of there, you are selling, 60% of the money you are selling is selling low. Right? So 0 people should be in a target date fund or a balance fund. It's a hot take, but I'll stand by it. Does that make sense? Because we lack the ability then to pick and choose where we pull stuff from. So if you want to be 60-40, then be 60-40, not 60-40. 60% equities, 40% bonds. So that would be one piece of homework for you. Go check your portfolios. If you have a balance fund or a target date fund or a life cycle fund or any of those, then someone was lazy and they just shoved it in that one fund instead of actually having a strategy for you.
Could you say those 3 funds again?
Yeah, so they'll be called like balanced fund, target date fund, life cycle fund, or like life strategy, anything like that. If it has a number like a 20-something, 2035, 2025, something like that on the back end of it, then it's a target date fund. That date is the year that they're trying to get to, like 60-40. Right, so if it's a 2045 target date fund, that's when they're trying to get to it there. If you have a 2025 one, they already hit it last year. Right? Yes?
Question about equities or determining an equity. Latest thing in the market is these covered call options.
Mm-hmm.
So what is an equity? Would you almost equate that to a bond, a fixed income?
It can be, but then you also run some separate risks of what if they go wrong. So he asked about like covered calls and some of these other kind of things. And so you can, right? You can say, hey, I've got all this money, I want to sell options, stuff against it, get some income, etc. I've seen some of those go wrong. To me, again, I'm not trying to optimize return on my fixed income. Because you can get more than this by doing stuff like that, right? Or bonds can pay a little bit higher yield. But if I get 4.5% in a bond, so 0.5% more than something more stable, right? But then right when I need it, because I'm trying to sell out of fixed income instead of equities, the value of my bonds are down 7%. Well, I hope I've held that for 14 years then to make up for the 0.5% extra yield I got when I had to sell it down 7%, right? If I have to get rid of those, if you're doing this strategy, right? If I have to get rid of those covered calls, or if I have to sell the assets out from under, or whatever else, like you just mess it up, right? And so I personally don't. You could, but I like the ones that just I know work.
What if it's in an ETF, shortfall ETF?
Same basic risks are going to apply, but like slightly, dispersed a little bit. Again, I just don't. There's a lot of things I just don't do. Most people, right? A lot of it is we're looking for alternatives. We still want to get this, but we don't want this. And almost all of them have a catch somewhere. You just got to look hard enough to find it.
So do you go heavy on your equities for consumer products, Procter & Gamble, that sort of thing, to kind of balance out how much it's going to drop? Because people always need.
Yep.
They need, right?
Yep. Yeah. So I wouldn't have it, right? So I wouldn't have it. Yes, I would diversify then inside the equities because some will fall more than others. So great example. So 2022 to 2023 was the last like real bear market we had, right? It ended up being 30% down at one point, 25% down at the end of the year, then came back up over the course of the next year, right? And during that time, large cap growth, Apple, all these kind of funds, right, was doing the best up till then, and then it did the worst. And then it went on to do the best again, right? So it was down 30-something% that year. And large cap value was down 2%. Right, so if you owned both, and fixed income was all down because all the interest rates were going way up, so all your values were coming down, and so like long-term bonds were down 25%. Short-term bonds were down 12%. Supposed to be safe, right? Your fixed income is supposed to be safe, and it was all down double digits. And large cap value was down 2%, and then was up 9% the next year. And so guess where we pulled all of our retirees' income for that year? Large cap value. Because if everything else is down 20, 30%, and we're only selling down 2%, that's a win. But you can't do that if you're in a total stock market fund or a life cycle fund, right? So you want options, and then inside of here you want options. So you can pick and choose where to pull things. So that, right, some things are going to be down more than others, and some things are going to be up more than others. And to have those options of where to pull from matters. Yeah? Helps a little bit? Okay. Anything else in here? Otherwise, I think we're pretty much done. So I'm going to put it right in the middle, right? Because if you are doing this, you can pull more than 4%. You should be able to average 5, 5.5, 6% a year doing this method. You have to be able to flex sometimes. Sometimes you have to go to the Wisconsin Dells instead of Hawaii, okay? But if you can flex a little bit with your retirement income, you can on average get 5, 6% a year doing it this way. So does better than your 5% flat withdrawal rates from your annuities, etc. Goes in the right direction because it gives you plenty of growth. So if your accounts are still growing, your income's also growing. Right? And then if you're living off the growth and it's still growing on average more than you're pulling out, right? If you're averaging 6, 7% growth and you're taking out 5%, then you're still growing on average, which means it doesn't matter how long you live, you're going to have as much or more than you started with. And so then it passes the duration, and not only does it last as long as you live, it lasts longer because you have something to leave to the next generation, unlike annuities, Social Security, pensions, etc.
Can you have the beneficiary of your, let's say, IRAs go into a trust?
You could.
Managed by a future generation?
Yeah, you got to be really careful with IRAs and trusts.
Okay.
Because if you don't do it right, then it becomes it pays all out at once. and that trust tax rates, which starts at 35%, and then is taxed every year at 35. It's like you can do it, yes, but I wouldn't use LegalZoom for that. Yep. And we'll get into some of that in the next one. But okay, so I think that's it for retirement income. So, right, in exclusion, like the way we teach it, it's not the way almost nobody else teaches it this way. I'm not the only one, but it's rare. 2 to 5 years of withdrawals in fixed income, invest the remaining in equities. You withdraw from your equities when they're up. You withdraw from your fixed income when the equity values are down. You replenish the fixed income in up years. Repeat forever. Right? Easy to do when the market's at an all-time high. Hard to do when it's dropping and everything is very uncertain. And that's where we come in.
So when you look at trends, I guess what worries me is I look at the market and I look at, it sounds like there's a group of AI companies that are really dictating kind of the growth, the overall growth of the
Sure.
market. How confident? I mean, when you see it go to all-time highs like this for such a sustained period, when you look at the trends, have we had a period quite like this? I don't remember that in my lifetime. It feels like everything is always positive.
Yep.
And that worries me a lot.
Yep.
I look at that and go, how is this sustainable?
Yep. Yes.
Particularly when you look at the national debts, you look at bond rates going up.
Mm-hmm.
You look at the dollar, and so how much of the market up, let's say it's up 15%, but the value of the dollar is down 15%.
Yep.
There's just a lot of things here that I find this a very tenuous period.
Doesn't seem to add up.
Yep.
No.
Yep. Yeah, so he's asking about like, what about trends and all these things, and like AI companies seem to be ruling everything. Like, what's going on here? Like, how much do we trust it in today's thing, right? And part of it, yes, we have seen this before in the 90s with .com, and then that didn't turn out very well for people who put 100% of their stuff in equities, right? 100% of their stuff in .com companies or AI companies, which is why we wouldn't do that. So diversify, right? But like every time you think it was right, there was like again. I think the best example in recent history is COVID, right? Market went down 35% in 33 days, sharpest drop in history. The entire world was shut down. Market recovered. 2020 is a positive year in annual returns. Market was still closed. The economy was still closed. So everyone's like, oh, the second shoe's going to drop, right? 2021 is going to be a disaster. Nope, 2021, 20% plus returns. Right, and so when in the Great Financial Crisis, when the Bureau of Labor Statistics, which officially decides when a recession's happened and when it's over, finally said, hey, the recession's over, the market had hit all-time highs again like 8 months earlier. Right, so if you're waiting for the news to tell you now is the good time to be a business owner, you will never get it. And you will keep missing out on all of the growth in the meantime. So are we going to put all...
People sold,
Yep.
and because they panicked, they're the ones that lost money. The people that
Correct.
stuck with it and didn't look at their statements.
Correct. And specifically if they were in retirement. And so we know people that had to go back to work. They retired in 2007 and then they had to go back to work. Well, either they panic sold and then the market returned without them and then they didn't get it back, or they were just spending half and half out of their 60-40 fund and so they didn't let it recover, right? This would have survived that. No problem. And every other one in between. But you have to stick to it, and a lot of times the human behavior is way harder than the economics, the financials, the fund analysis, all of that. So, okay. Real quick then, you would want to integrate this with Social Security, right? How does this play into Social Security? You would want to integrate it with tax planning, which we talked about last night. Right, so as you're pulling from red and blue equities and fixed income, are you also pulling from IRAs, Roths, 401ks, et cetera, right? How are you managing those? And then integrating with estate planning, right? Where is it all going in the end?